Greetings once again and welcome to the 10 of this training program. Now, yesterday we talked about other blocks, all right? We talked about bullish and bearish other blocks. We talked about all the various characteristics of good other blocks, and we put all that together. So today we're going to be talking about fair value gaps. All right. Now, this fair value gaps is a term that is coming under what we call imbalance. An imbalance. All right. This is coming under this term we call an imbalance. So we have fair value gap, imbalance, fair value gaps. Now, this is what we're going to be discussing today, what an imbalance is, and that of a fair value gap as well. So basically, right, just from the name, an imbalance, it actually means there is an inefficiency or there is something inefficient, all right? There's something that is not efficient. It's just like you share something for two people and it's not equal, right? You can say it is not balanced. So it's just like you say, okay, this is not balanced. All right, let me put that correctly. Okay, so now an imbalance in the market, just to put it in lay terms, is a situation where we have buyers, all right, where we have buyers and sellers, and the volume that they are bringing in is not equal, all right? It's just like we have about 100 million buyers buying an asset, and we have just about 1 million sellers. So in this situation, what has happened here is that the buying pressure, the buying volume, which is a demand, is actually far more than that of the supply or the selling volume. All right. When this happens, it causes an imbalance in the market. All right. It causes an imbalance in the market. And now what actually causes price to move is always this imbalance. It's always this imbalance. All right. What causes price to rise and drop is based on this imbalance. All right. Because when you are looking at the market, unless buyers are more than sellers, prices will not rise. Unless sellers are more than buyers, price will not drop. All right. This simply means that unless demand is greater than supply. Remember the lesson we had on how to read on understanding how the markets move, right? We said when the demand, all right, when the demand is more than supply, that means people want something more than what is available. What happens? The price increase, right? So when demand, which is under buying pressure or buying volume, when it is more than the selling pressure, what actually happens is that prices increases. All right. Now, this imbalance between the demand and the supply causes what we are talking about today. All right. So an imbalance is just a term that explains the inefficiency between buyers and sellers. Now, to point it on the chart brings us to what we call now a fair value gap. Now, this imbalance in price delivery causes these FVGs, all right? You can call it a fair value gap or an FVG. Now, let me just look at an example here on the chart. Now, when you see price moving like this to the upside, what comes to your mind? It tells you that there is enough of buying volume here. There are enough buyers in this particular swing move, which has not actually even allowed sellers to come in. All right, so you barely see the footprints of sellers in this market, which means we are not even seeing a bearish candle, right? So, but sellers actually participating, but they are very, very limited. They are small. All right, it's just like the example I talked about: 100 million people that are buying, and just about 1 million people that are selling, which allows the prices of it to increase. All right. Now, this is actually euro. Now, let's say that 100 people are buying euro. Now, if 100 people are buying euro, all right, and only 1 million people are selling euro, what should happen? The prices should increase, right? It's normal like that. The prices should increase. So that is actually what we can see here. And this is an imbalance delivery, all right? It shows an imbalance in delivery. Now, as we move forward, I'm going to be explaining to you guys deeply what actually this is. Now, within this imbalance movement here, In between, we're going to spot what we call fair value gaps. All right. Some other people still call it imbalances. No big deal, but I'm going to explain to you how to spot it. All right. Now, understand that the way the market move aggressively to a particular direction is always caused by that inefficient movement between the both parties. Okay. Now, talking about the fair value gap, I think I've already explained what an imbalance is. Now, let's talk about the fair value gap. Now, a fair value gap, now to spot a fair value gap is it's something in a 3-candle pattern. All right. It is based on 3-candle pattern, which means we have candle 1, we have candle 2, and then we have candle 3. Now, all these candles have their wicks normally. All these candles actually have their wicks like that. All right. Now, this is candle 1, this is candle 1, this is candle 2, and then this is candle 3. Okay. Now, with this 3-candle pattern, before you spot a fair value gap, it is always within 3 candles. All right, it is always within 3 candles. Now, where is a fair value gap here? What am I actually talking about here? Now, these are bearish candles, right? These are actually bearish candles. Now, if you look at this bearish candle, remember that this first candle, this number 1 candle, it first of all, it opens up here. This was the opening price. A bearish candle opens up, closes down. Now, it traded right down to this point. Okay. Now, if means that when you see on my right here, these are prices here, right? These are the prices, the prices for this particular euro. Now, let's say on my right here also, it is the prices or the rates of the euro, right? Here. Now, we notice that this euro, at this moment, when this candle traded down, sellers push price right down to, let's just say here is around 3. All right, let's just say here is about $3. Now, it means that sellers push price right down to 3 within this single candle, all right? And then buyers came in because for a candle to drop and buy and go back up, it is buyers that are actually pushing the market, right? So buyers were able to push back price to come up and close somewhere here, and then the next one opens. Now, when the next one opens, buyers continued again, push it right up to this moment, and then sellers came in. What happened? Sellers came in, push price right down to this point, all right? And what happened? Buyers came in, push price again right up to this point, and the candle closed. When the candle closed now, what happened? The next one opened, and buyers again tried to push price up again. But this is where they ended. Sellers overtook the buyers here. Let's say now this is within 2, right? Or let's say this is 1.5, something. Now, if you look closely, or if you're following me closely, you will notice that this was the last price point where buyers were able to push down price to, or push back prices from. And then the next point was here. So this actually means that the prices that is in between this 3 and 1.5, we have not had any buying pressure. Buyers have not been able to push price around that area. All right. Now, this is what now we call a fair value gap. It is a price gap or an imbalance between 3 candles. All right. It is a price gap between 3 candles. This is a situation where the wicks of candle 1 does not intersect with the wick of candle 3. Now, if this candle 3 could have traded right up to this point, this will mean that every price range within this movement here have been balanced, which means buyers have bargained whatever price that was between this price movement here. All right. It's just like they are selling something and they're gradually increasing the price. Let's say they start with 10K, they leave from 10K, they go to 11, 12, 13, 14, 15, 16, 17, 18. And when they reach at 20, they just move from 20 now to what? 100K. Now, between 20 and 100K, this is not as efficient as this was. So there is now what we call here now an imbalance, or a fair value gap has happened within this area. All right. There is a huge price gap here. Price did not leave from 20 to 21. It just leave from 20 to 100K. So there is a price gap. All right. And that's what we see with this candle right here. So this is a fair value gap. From the low of this candle to the high of this one is what we call a fair value gap, all right, an FVG. It is what we call an FVG. Now, why is this important, as you guys will ask? Why is this important? Why am I talking about this? All right, now, remember, for every business to move well, the opposite sides or the opposite participants must be present. They must be active. If you have a business that is constantly just killing the other party, it will not last. All right, it will not last. So what this means is that when price creates this imbalance, all right, when price creates this imbalance, for the market to move perfectly, the market must be balanced, all right? There must be that balance between buyers and sellers. There must be that balance between buyers and sellers. So which means that subsequently, the market is going to do what? The market is going to trade back into this area. The market is going to trade back into that area of fair value gap. Okay, we're going to have a candle that maybe will trade back like that. Okay, and then trade into this gap. If it trades into that gap, maybe another one opens like this and then trades somehow like that. Okay, and then we have a continuation back to the downside like that. Okay, so what has happened here is that price has filled the gap that we had. Price has balanced this fair value gap. Now the fair value gap has been filled. Now sometimes it's going to fill completely. Sometimes you fill to the center, which the center is called consequent encroachment, or sometimes it will just get in a little and then it continues to move lower. Now, why am I talking about these fair value gaps? Remember yesterday we were talking about what? The internal types of liquidity. All right, the various forms of internal range liquidity. We already talked about order block. We want to understand why price doesn't move on a straight line, why it will go, it will expand and pull back, why it will expand and always come back. Now you have already understood now two various things, okay? Two scenarios where price will expand and then have to come back. The first one is an order block. The first one is an order block. Price will expand like that and then it will come back to mitigate the order block that we have here. Now, when price comes back and mitigate that order block, what has happened? The internal range liquidity that was here has been mitigated and we expect another expansion to the upside. Now, sometimes price will expand to the upside like that and then we'll have a fair value gap here. Okay, sometimes price will expand like that and a fair value gap will be formed somewhere around here. Maybe something like this. Okay, now when we have something like this now as a fair value gap, remember I said from the high of this candle to the low of this one, you extend it to the right. Now what will happen now is for the market to be efficient, we wait for price to come back, balance this fair value gap. All right, when price comes back and trade inside this area of the fair value gap, FVG, it means now the market has rebalanced its the imbalance that we had, and then we can expect price now to continue higher. So we already have two reasons or two things to expect, or two things that we can always look for when we are expecting price to come back for an imbalance. Now, you guys will ask me that, okay, how would you know whether price will go back to an imbalance, or how would you know if price will go back to another block? Now, one thing that you need to understand is learn all of them, but you can now decide to master one. There are still some things that I'm going to tell you guys as we move forward, which will make you to know sometimes you prefer an order block. All right, I think we talked about elements of a good order block, and I actually did not mention about fair value gaps because we were yet to go into that topic. Now, there are some strong order blocks. All right, you consider some order blocks to be strong because they have fair value gaps. All right, or how will the fair value gaps be? Now, if this our bearish candles, now for some people they don't trade order blocks that doesn't have fair value gaps. What that means is if price creates if price creates an order block like this, all right, if this is our last bearish candle, the black one, now the preceding candles, all right, the preceding candles after that order block has been formed must create a fair value gap. Okay, now when it creates a fair value gap, that is one element to tell us that we are having a strong order block. Why? Remember, we mentioned that this fair value gap that we are having is showing us that there is a huge difference between the volume that has come in the market. It is showing us that there's huge buying volume in the market. So therefore, this huge volume that we can be able to spot in the form of a fair value gap actually makes this order block to be a strong one, or actually tells us that, okay, the volume that got in on this order block is quite heavy. So it means the institutions are involved. They are the ones that are sponsoring that move to the upside. So what happens? We now simply wait for price to come back and mitigate the orders, all right, and indicate their positions that were there on that order block, which means we simply wait for price to come back to the order block and we buy. Now you will notice that I did not say price will come back to the fair value gap. Now you will now wait for price to come to the order block and you buy. Now sometimes price will just reverse from the fair value gap. What happens in those situations is, if this fair value gap or if this order block has been mitigated probably by this candle, all right, sometimes the market will just reverse from the fair value gap, all right, especially if this preceding candle traded right back down into the order block. Most of the time price will now not come right down again to the order block again, because this movement already mitigated the candle. All right, so most of the time now price will just know that, okay, I have just this liquidity here to rebalance and continue. All right, but in this case where the order block is unmitigated, price had two things to mitigate. All right, the order block and the fair value gap. So if price is coming down to the order block, it is as well mitigating the fair value gap and the order block as well. All right, take note of that. With time, as we move forward, I'm going to give you so many things that you can consider when you are trading, when you choose order blocks alone. But actually, I've given you guys everything that you need, which has to do with order blocks. I've given you the characteristics of the things that makes an order block to be strong. We have talked about sponsored candles, which means you see this type of movement of candles creating fair value gaps. That is what we mean by sponsored candles. That's candles with healthy bodies. All right. When they are creating that imbalance, it shows that the volume involved is actually huge, and you understand that the institutions are the ones bringing in that volume. Also, we talked about break of structure. When that volume comes in, it shifts price to an extent that you will do what? You will break structure. Now there is one that is left, which is called liquidity gap, which is, we are still going to talk about it in the future. But for now, I've given you guys everything that you need actually to start trading order blocks if you can be able to practice it diligently. Remember, you have to go to your charts, practice it before you can now start trading it on a live account. All right. If you don't practice on a demo or practice it first, when you start trading live, you will not actually know what you're doing. All right. It's just like, you know that there's a fighting competition and you are not practicing to fight. You just want to go to the day of fighting and then you enter the ring. They are going to blow your head. All right. So preparation here is very important. When I teach you things like this, what you have to do is go to your charts, you study them, you mark out as many as possible, and then now you have imprinted those images on your head. Once you see them on the chart, you'll be able to spot them as easy as possible. Now, if I just call any of you and say, all right, let's sit together, I will just be scrolling my chart, I will just replay my screen. Let's just say, okay, I just call you, I say, all right, this is my screen. The moment an order block forms, you let me know. All right. Believe me, you will not be able to do that. Why? Because you have not yet ingrained those images in your mind. When you see the candles moving, you will not know that, hey, this is an order block that has been formed. This that has been formed. You would not actually understand it until you have practiced enough to know that, okay, hey, there is another block here. Look at this candle. Look at what happened here. You say, okay, this is the last down close candle here. Look at how price went up and break structure. Look at the bodies of the candle. This is a fair value gap here. Look at, there is a gap between the buyers and the sellers and all those things. If you don't practice, you will not be able to spot these things as easy as that. You understand? So this is why it is very important for you to practice. If you don't practice, you will not be able to sit on the table that you are trading and you see it and you just recognize it like that. No, it will be very difficult. All right. So once I give you this information, go to your chart, study it. You must not use a replay mode. Just scroll back like that, like we did the time we were looking for other blocks. Just scroll back like that. You see another block, you mark it out. That's how you are going to learn. All right. That's how you are going to learn. Now look at this one. See that? All right. Let's continue. Now, we've talked about fair value gaps, right? Remember, you're going to see fair value gaps everywhere on your chart as well. All right. Remember, I said a strong move like this one is an imbalanced movement. Now you will notice that some of the time price will fill a gap like that, and then on the next candle will trade into the gap and fill it, and then it continue higher. Just like that here, you can also see this was a fair value gap here. From the high of this candle to the low of the other one, you can see how price traded back into it here. Once price fill it, price continues higher. So this area has already been balanced. Okay, now there are so many fair value gaps that when you look on the chart you're going to see, but there is a way you trade them. You don't trade fair value gaps against the overall market structure. Remember, we talked about market structure, right? If the institutions are selling, you should be looking for only opportunities that will support the selling buyers, right? If the institutions are buying, you should only be looking at bullish order block at bearish order blocks to sell along with them. If they are buying, you should only be looking for what? Bullish order blocks to buy along with them. Okay. Now, when you go to your charts now, you're going to see that, okay, I noticed price reversed from this point. You now try to understand, why did price just trade up into this area and started going down? You notice that, hey, it was filling a fair value gap, and that's it. You will notice that, okay, look at this huge move to the downside. What happened? This becomes another block. You see price went back up, dropped lower. These are the things that you can only you become used to them when you have practiced and practiced and practiced. Okay, now look at this scenario here. You are going to notice that sometimes the market will be buying and giving you fair value gaps and still selling and giving you fair value gaps. This means that, let me actually look, okay, now, for example, look at this one. The market is in an overall sell program, right? It actually created a bearish fair value gap here. Now, I don't want to start talking about CBs and BCs. Just understand there are bullish fair value gaps and there are bearish fair value gaps, which means there's a fair value gap in the sell direction, just like this one here. We have a fair value gap that is going to support price to continue selling, right? A fair value gap that will support price to continue selling is a bearish fair value gap, just like a bearish order block. Okay, but now look at this scenario here. This was a fair value gap which supported price to continue the downtrend, but now also we had a bullish fair value gap which did not support price. This is the scenario I said, okay, even on a downtrend, you are going to have bullish order blocks. Okay, even on a downtrend, you are going to see some things here like bullish order block, but they are not going to hold because price is overall bearish. So what happens is concentrate more on things that are dealing with what? The bearish pressure. All right, so I think I've explained that. With time, we're going to, as we'll be discussing, having live sessions, I'm going to be explaining most of these things deeply. And also, if you want to learn more about them, you can also visit my channel, and then you see a lot of videos that I've made there on fair value gaps, even other blocks. Okay. All right, let's see. Some people ask some questions. Imbalance not spell well. So, okay, I think I have now. Thank you for that. Is it possible for an order block to mitigate twice? Yes, it's very possible. Please, which time frame is best for identifying another block? Boris, it actually depends on you, okay? It depends on which type of trader you are. Let me go to the 5-minute time frame and show you something. Let's just go to the 5 minutes. Now, this is the 5-minute time frame. If we are looking at this 5 minutes, we are going to see another block. You understand what I mean? Even when you are looking at the 5 minutes, what you are going to do, you are going to see an order block. All right. Look at this movement here. You can see how the price went up from this point so heavily to the upside. Now, if we mark out this order block directly to the right, you are going to notice that we had what? An order block at that moment, at that point, right? The last down close candle here, you can see how price moved up. Now, when price came back to it, it started buying. Take note, this that has happened here, this could not be the 5 minutes. This is what we say price is what? Price is fractal. When they say price is fractal, it actually means these candles that you are seeing like this, they can be the same candles on the daily, they are the same candles on the weekly, same candles on the yearly chart, same candles everywhere. The only difference is that these candles here, they are taking only 5 minutes to open and close. All right, that's the only difference. It's taking only 5 minutes to open and close. Just like, okay, for example, this is a fair value gap now on the 5-minute time frame. See how price came, feel it, and just went back up. Now, if you still go on the weekly or daily, you're still going to see the same fair value gap filled in and price moves up. Look at this other block. You can see how price came to it, bought up so massively to the upside, created an imbalance, fill it back, continue higher. What I'm simply saying is it depends now the type of trader that you are. I mentioned the last time that we have what? We have scalpers. We have scalpers. We have short-term traders. And we have day traders. Sorry, we have day traders and we have short-term traders. We have swing traders and we have institution position traders. With scalpers, they are the people that are dealing with a 1 minute chart, maybe up to 15 or 5 minutes. They are dealing with charts that have they're dealing with lower time frame charts, like the 1 minute, seconds chart, and so on. All right. With this type of people, they can open a position now, and in the next hour they have closed. In the next 15 minutes, they are done. In the next 10 minutes, they are done. In the next 30 minutes, they are out of the trade and they are done for the whole day. Somebody can trade within 30 minutes and make over $1 million. That's who scalpers are, right? There are people that are very smart and quick in decision making. Now we have day traders. Day traders are people like us now that, okay, in a day, I'm planning to take one trade. Maybe you can take the trade in the morning and I close around evening, right? We have short-term traders, people that can hold trade for a day or two. We also have swing traders, people that can hold trades for weeks. All right, you can hold trade for a whole week. You can hold trade for 5 or 4 days and 3 days and so on. We have people for position traders. They can hold trades for weeks, years, and months. Now, the difference here is that if you are a scalper, you don't have too much business to do with what? The 1 month time frame. If you're a scalper and you're looking at the 1 month time frame, when do you expect it to ever close before you make a decision? You now understand the difference. If you're a day trader, you can be looking at the 5 minute, 15 minute, 1 hour time frame and the 4 hour, because it's not going to take the whole day for the candle to open and close. All right. So as a day trader, you can be looking at other blocks from 1 hour, 4 hour, and the daily chart itself, right, to understand. But even as a scalper, you need to mark out these other blocks and fair value gaps on the higher time frame, like 4 hour on the daily, so that you have it on your chart, so that you're on the lower time frame, you should not go against those higher time frames. What I'm simply saying is that, okay, if you can actually mark out something like this. Let's say we have an order block here. All right, this is the daily time frame. This is a daily chart, and then we have a bullish order block. Now, what happens here is that this is the daily coming back to it to continue buying, right? Now, this is how the 15-minute will look like here. The 15-minute will be giving us a downtrend. Now, if you did not look at the higher time frame, you will not know that there's a very strong support level here, which is what? The order block. So it's always good to have a look on the higher time frame, so that you know that, okay, there is a strong level of support that this lower time frame cannot overtake. So that as price is coming to mitigate the week, daily, and continue higher, you will not be confused on the 15-minute as it's showing you a short pullback as a downtrend, right? This which time frame is behind the other block? I think I've answered that. What do we do when we have consecutive fair value gaps in the same position? You just scale up to the higher time frame, TCN. When you have so many fair value gaps at a certain point, go to the higher time frame, you will reduce those fair value gaps to probably one. All right. Or you wait for price to come into it and then you wait for a confirmation, probably a shift in market structure on any of them before you buy. Let's say you have two fair value gaps and you're wondering which one price will respect. Wait for price to come to it. You go to the lower time frame and you wait for a break of structure to your direction before you buy. That's what we call confirmation. There is a situation where on an FVG the wicks touches each other, but price respects the zone. There is a situation where on an FVG which touches each other, but price respects the zone. Yeah, price can respect the zone is a lower time frame order block around that area. I think of that understood your question. There is something there on the lower time frame, either a mitigation block or a breaker. I wanted to speak so you get what I wanted to say. We're actually out of time. Probably tomorrow. Tomorrow is Friday. Yeah, we're going to have session tomorrow. We'll revise fair value gaps tomorrow, and then we'll go straight to breaker blocks and mitigation blocks. All right. So guys, we're out of time. The recording will be available probably in YouTube or Telegram. All right. So make sure you go and you do your exercise.